What's up? Welcome back to another episode of Real Estate 101. And today we're going to be diving into the topic of seller financing. But before we jump into that, please take a moment to like this channel, subscribe, and if you like this video, please share it with your friends, family, grandma, whoever. Seller financing. So what is that? What does that even mean? First of all, seller financing is a type of real estate transaction where the agreement allows the seller to extend the line of credit to the buyer in installments rather than using a bank, a credit union, or any other financial institution. A seller financing agreement functions along similar lines of a mortgage loan, except that it cuts out the middleman and allows the home seller to oversee the deed, or the debt rather, instead of a traditional lender, also known as owner financing or purchase money mortgages. So what are the different types of seller financing agreements? You have land contracts. A land contract is an agreement to purchase a piece of real estate that involves borrowing money from the real estate owner until the purchase price is paid in full, rather than the credit union or, again, financial institution. Land contracts typically work in a unique fashion, where a balloon payment or a lump sum comes at the end of the repayment period, usually 5 years, whatever's negotiated between the two parties. Next, you have assumable mortgage. An assumable mortgage is kind of what it sounds like. You assume the owner's mortgage. It's a type of home financing in which buyers are given the opportunity to purchase a home by assuming the responsibility and taking over the seller's mortgage, especially if it's charged at a lower interest rate. Next, you have lease purchase, which is something I've done with the condo that I'm standing right now recording this video. Also known as a rent-to-own contract. A lease purchase agreement speaks to a form of agreement under which a renter pays the seller an option fee at an agreed upon purchase price. So for my apartment, we agreed $750. That's what we're gonna buy. We did a down payment, and then we agreed upon and negotiated a rental price for the 1 year period. And we have until the end of the lease the right of first refusal to purchase this apartment. So that's typically how a lease purchase agreement works. We have till December to pull the trigger whether to go for it or not. If not, then I have to allow the owner access to the apartment to start showing it for sale once again. So that's a lease purchase agreement. Next, you have land loans. A land loan is used to facilitate and finance purchase of a debt of a land for later use or for residential business purposes. Holding mortgage. Under a holding mortgage agreement, a homeowner agrees to serve as a lender for the home buyer and provides a loan for the purchase, which the buyer pays by making monthly payments to the seller. The seller continues to hold the property's title until full loan repayment has been made by the buyer. What are some advantages for sellers? Ability to save on closing costs, can produce significant capital gain saving taxes over time, faster sale and ability to sell your property as is without any need for repairs, because there's no appraisal, there's no bank saying this needs to be in that condition. So that's why it's advantageous for the seller on that part. You're released from the property tax, homeowner's insurance, and various maintenance expenses that come along with owning a property. And you have the option to sell the promissory note to an investor. What are the advantages for buyers? And honestly, the buyers have the greatest advantage in a seller financing agreement, if done right and they have a great attorney and a real estate agent like me. Great access to financing opportunities, especially for low-income buyers. Lower expenses associated with closing costs, more flexible agreement terms, potential for no PMI premiums, more accessible for those with poor credit. So keep this in mind if you have poor credit, that this can be a great option for you on the long term. And then once you build your credit up, you refinance, you pay the seller in full, and now you have a traditional mortgage on the property. So that is the great advantage of seller financing for a buyer. What are some disadvantages of seller financing for the buyer? Fewer regulations that protect home buyers. Buyers are still vulnerable to foreclosure if the seller doesn't make mortgage payments to senior financing. No home inspection, PMI may result in a buyer paying too much for the property. Higher interest rate and bigger down payment required when doing seller financing. Sellers face the risk if the borrower defaults on payment. Is seller financing a good idea? The answer is entirely dependent on your financial situation, your credit situation, and where you are in life. It can be a good idea. It might not be a good idea for you. If you can get a traditional mortgage, you probably should move forward with that. But for some reason, if something's preventing you from doing that, then maybe a seller financing is the best option for you. Thank you. I hope you enjoyed this video, and I'll see you in the next one.